Welcome to Dental Unscripted. Where Mike Dinzio and Paula Quinn break down the practice ownership journey, one episode at a time. Starting up, buying, and running a successful dental practice.
What up, guys? Welcome back to another episode of Dental Unscripted. As you guys know, this is Michael Dinzio, one of the co-hosts of the program. And if you guys are big YouTube followers, I'm sitting in my living room, so the sound is not my weird podcast booth that I sit in. But that's just how today's going. And so here we go. Today's I'm super excited about today because we are me and a friend of mine that's big into the accounting world. I refer a lot of clients over to, we're going to digest everything that goes into the allocation schedule when buying a dental practice. And so we're going to break this topic of allocation schedule. But first, before we do that, little housekeeping. And before I bring on my guest, I'd like to invite you guys over to the Dental Unscripted channel if you haven't already done that. So I've talked to a lot of you on the phone that are followers of the program, and you haven't done that, do it. We will stop publishing on Dental Acquisition Unscripted, and we will stop publishing on Startup Unscripted soon. So please jump over to simply Dental Unscripted, the channel, because we're just bringing both brands and both channels into one. And we are going to be talking all things start, all things buy, and also how to run a dental practice as well. So please join us over here, like, comment, subscribe, all the things. Okay, without further ado, let's bring in Morgan Hamon. Morgan has been working with me for many, many years on lots and lots of deals. He's a wealth of knowledge. Morgan, welcome to the program, man. How you doing?
Thanks, Michael. Thanks for having me. It's good to see you again.
Yes, sir. Yes, sir. Why don't you tell us a little bit about your firm? I know you guys just went through a merge. Congratulations again. I mean, you guys started a fantastic accounting firm and just brought in more resources, which is exciting. But why don't you give everybody like a breakdown of what you're doing today and what the company's all about?
Yeah, you bet. We started in 2010 as HDA Accounting Group, and so we've been at it for 15 years supporting dentists who own their private dental practice, very much a niche firm. And as we've grown and scaled, we decided, we were at a point where we wanted some additional resources in the form of technology and staffing, which is always important in accounting and tax. And so we recently combined with a top 20 firm, EisnerAmper, and they have organized us in our dental specific subsidiary, Eisner Advisory Group Dental Advisors. I'm the partner in charge, have all my team. We're still doing our same core services, which is the monthly accounting, the profit advising, and the tax planning. Only now we get to offer so much more and have a more comprehensive experience for our clients. As an example, this morning, we just sent an announcement out. We can do cost segregation studies now, and we already have. That went out at 9 this morning. We already have like 3 doctors that are saying, "Hey, look, we want to talk." So we can add a lot of value as part of EisnerAmper now. So it's been just a natural progression as part of our journey, but it's still very specific niche, private dental practice owners only. That's our world.
I mean, just cost seg, picking cost seg up is huge for the listeners.
It's huge, yeah. And the price point's great too. I mean, we're super excited, and so we're just getting started with that. But it's been really, really wonderful.
I love it, Morgan, man. Like, congratulations on that success. And the first question I asked you was, is the fee structure going to change? Is the service going to change? Because that's always the big question.
Yeah.
Your answer same. Is no. And my clients that we sent over just more recently, the answer is no. So
thank you. Yeah. Same people, same service, same responsiveness, because we all have the same tools. We just get to add a lot more to it.
That's awesome. That's awesome. Well, let's get into this topic, allocation schedule, because it feels like every day I have to kind of get in, and I'm like, look, I'm not a CPA. I just know enough to be dangerous. And I thought, well, let's get a CPA on the program, and let's just kind of diagnose this kind of issue.
Yeah.
But the first thing to hit.
What is it?
What is it?
What is
the allocation schedule? Yeah.
As you know, you're heavy into the transition space. We're not in the transition space. We certainly advise on it. And when it gets to this particular topic, so the first point of negotiation is the price, of course. And then once that price is agreed to, then we have to decide, okay, how are we going to allocate that price among the various assets that are being purchased? Because these are all asset purchase agreements. So broadly speaking, there is the used equipment, there is the patience, there's a promise not to compete, and then we might, generally it doesn't get too granular, but you might break it down to some supplies, and sometimes they might say, well, this is medical equipment and this is furniture, but I kind of group those as fixed assets. So there's generally like 4 or 5 main categories where that purchase price will get allocated.
And I've even seen website thrown in there too.
Sometimes you can get as granular as you want. I think of it honestly, Michael, like you break it down, and you and I both know there's sort of 2 main categories. It's the fixed assets and it's the goodwill.
That's right. Yeah.
And just so you know, the promise to not compete, that should never be more than $5,000. It should just be a nominal amount, but it's usually just it's the assets and the goodwill.
Morgan, can I ask you, like, why do some people get more granular on the topic? Like, what's the purpose of chunking this thing up? Because you're right, it's like, okay, there's the equipment and then there's the goodwill, and that's really it. So why do they do that with the goodwill?
Oh, well, with the goodwill it's very important. And we'll talk about that consideration with the seller. But if people want to get granular into the website, and I've got these supplies, and you got to buy, I don't think it serves much of a purpose. It doesn't really have a material impact on the taxes. And so when you see an agreement put together by, I think, somebody who does a lot of dental transitions, you don't see it broken down like it. Typically it's 4 or 5 categories.
Well, I have seen brokers get more granular. I'm like, why are we doing this? But I felt like they had a reason for it, but
not really. So if we think about it, and there's two perspectives, and they're very different. There's the seller perspective and the buyer perspective. And within each of those roles, there's competing objectives. Right. So what's the buyer, what's good for the buyer is the opposite of typically what's good for the seller. So I think maybe we start with the seller, because
let me recap. So the allocation schedule, just kind of throwing it out and just making this super simple, is you got the purchase price, let's just say $1 million, and we have to define how much of this $1 million of the purchase price, whatever it is broken up into hard assets, which is the equipment, and not so hard, soft assets, which is what we all call as goodwill, right?
Intangibles, you bet.
Intangibles.
And the other thing we might want to throw in here, Michael, is that this is an asset purchase agreement. They're almost all asset purchase agreements. So when you buy a dental practice, you're not buying that dentist company. You're buying their stuff, and you're going to put their stuff in your own brand new company, and you're going to start day one as your whatever PLLC or PC you set up for yourself. So you're just buying their assets, and that's why it's an asset purchase agreement and why we're allocating those assets.
So versus, and I know, but just for the audience, versus a stock sale, right?
A stock sale, which is a horrible deal for the buyer, and you should never do that, because a stock sale is not deductible for the buyer. And then you're on the hook for all prior liabilities of the seller. So if they didn't pay their payroll taxes from years ago and didn't disclose it, it's still your problem. So you almost never see a stock sale.
I don't either. I don't either. So can you say that a little bit more simple? So everything that we touch, and I honestly don't think I've ever done a stock sale.
No, stock sale is you're buying the other dentist company. So if it was ABC Family Dental LLC, you're buying their stock certificates and saying that is now my company.
Okay.
The problem with buying stock, it's just like buying stock on the stock market. You can't deduct that. It's non-deductible.
So the allocation schedule is moot point with the
Doesn't
stock.
matter. You're
Yeah.
taking their balance sheet. You're also taking all their liabilities.
Yeah, liabilities, taxes, all the
So
things. But I have heard of some stock sales before when like very, very unique situations, right?
the only time I've heard of it and seen it is if somebody's selling a piece of their practice. And so they want to sell maybe 50% of the stock if they have an existing S corp, which that, Michael's, a whole separate podcast because that's so adding a partner is a whole new topic to visit about.
Okay.
But
Yeah.
so I will just call it 99% of the time, it's an asset purchase. You're buying the doctor's assets. You're buying their fixed assets and their tangible assets. You're going to put them in your own company.
Perfect. Okay. And so because the show has gotten more broad over the years, it's not just buyers that are listening. If I helped you, or if you've been listening for 5 years, I'm getting calls today. My younger docs wanting to sell to DSOs, or hey, look, ownership's really not for me. I think I just want to sell and go back as associate. Totally fine. Let's hit both buyers and sellers, because
Yep.
Morgan, you might be helping sellers. I primarily help buyers buy, but let's hit the buyers first.
Let's hit the buyers first, and then we'll talk. And I think it's important, whether you're a buyer or seller, it's always helpful to know, hey, where's the other side coming from?
That's right.
What's keeping them up at night?
That's right.
So for the buyer, this is the key. This is a key concept. On an asset purchase agreement, as the buyer, you get to deduct 100% of the purchase price, no matter what. Period.
Say that again, because that's something I say on every deal, and it needs to just sink in.
It needs to sink in.
They oftentimes hear that just because the hard assets are lower in value, that they're not going to get write-offs. That's what they think.
I'm missing out, and so and this is as a new business owner, also an important key concept. You always get to deduct 100% of every business expense. Right. It's just a matter of timing of how soon.
Yes.
So that's where you start as the buyer. No matter what, you get to deduct the whole price in all cases.
Yeah. So when Morgan says
that Morgan, it's 20% equipment, 80% goodwill.
Okay. You may have, Morgan,
the buyer, the equipment, that 20%, you get to deduct that either right away or over 5 years. That's the choice. So as an example, medical equipment is deductible over 5 years, or you can say, everyone's heard of Section 179 that says, let's just deduct it all right now. The goodwill, 80% of the purchase price, that must be deducted straight line over 15 years. So that's why you'll hear people say, well, as a buyer, you want a high amount to fixed assets, so you can deduct it all right away. And then you can have your, let's just say you'll have your party a little bit earlier, right? You only get the tax deduction once. Do you want it sooner or do you want it later?
Yeah.
But you still get to deduct the whole thing no matter what. So it's just timing. The fixed assets, it's more accelerated. You can do it now. The goodwill, over time for 15 years.
Okay. So in reverse, Morgan, in reverse here. So you get to write off the whole thing. It's just how long do you spread it over time, right? It's kind of like a loan. The more you spread a loan payment out, the smaller the payment is. So that's essentially that amount. If it's goodwill, that smaller amount is the write-off every year. That's
Correct.
what I heard.
Correct.
So just to say it again, because I think you may have broke out if that was on my side or your side.
Yeah.
So so for hard assets, it's how many years, and for goodwill, it's how many years?
So there's a schedule for, it depends on the type of hard asset. The biggest one, the most consequential, is the medical equipment. The accelerated depreciation is 5 years for medical equipment. 5.
Okay.
Or you can say, tell you what, let's forget that 5 years. That's what Section 179 is. That says, you know what, you bought this used equipment. Let's deduct it all this year. Let's just take it all right now. So it could either be instant or spread out in the short term, and then whatever's allocated to goodwill is straight line over 15 years.
Okay. So as short as 5 years with hard assets, and then as short as 15 years on goodwill.
Yeah.
Okay. All right. So the other thing I want to comment on is when we kind of separate topic, but similar, when we're evaluating or coming up with true profit of a dental practice, this is an interesting little thing. Everybody always asks me about depreciation and amortization, right? So can we hit that real quick? Because isn't it it's related here, is it not?
So that's what we call, we put that what we call below the line, right? So if we're talking profit margin on a practice, that's before you look at depreciation amortization. So we do not factor that in. If we're analyzing a practice for profitability, the depreciation and amortization is not part of that discussion. That's the owner's tax situation. Same thing with like the owner S Corp salary, that's irrelevant. So if the practice collected $1 million and has a 40% profit margin before owner comp, before depreciation, before amortization, I mean, there's $400K in profit for the owner. So we do not factor in depreciation, and you know, you'll hear the term EBITDA, and that's what they're talking about there, earnings before interest, depreciation, amortization, because it doesn't matter. Like whatever the seller, whatever they chose to depreciate their assets, because you do get a choice whether you want to do bonus or Section 179. That's irrelevant to how the practice is performing financially. That's just the owner's good deal write-off.
It's just kind of another line. It's not an actual bill. It's their strategy, the seller strategy. And so, but is it true that goodwill is related to the amortization? Is that a true statement? Or because depreciation is
depreciation and amortization.
Yeah, go ahead.
Depreciation, you'll hear depreciation more related to like a fixed asset because it depreciates, like gets worse, less over time, or amortization over a period of time. They're really referring to the same thing. They're non-cash deductions.
Okay.
So let's say you're deducting your goodwill over 15 years. You get to year 10, so you still have the practice at that time, and you still have your 1/15th tax deduction on the goodwill. That didn't cost you any money.
No,
you spent that cash 10 years ago.
But is amortization goodwill and depreciation hard assets?
That's a good way to think about it. But it's the same thing. It's a deduction. They're both deductions. Yeah.
That's perfect. Okay. All right. So I wasn't really planning on going there, but since we had an account on the phone, you might as well go there, right? Okay. So back to the buyer's perspective. So essentially now we've got our asset groups, goodwill, hard assets. We've got the schedule now that you've laid out, 5 years, 7 years, 15 years, depending on what the accountant wants to do. And that's your job for them. Let's talk about what's the bridge there? Any other things that you're thinking about as far as like the buyer goes and what they need to be concerned about?
This is what I think about for the buyer. And I think to really understand like where to go for the buyer, you do have to have some knowledge of where the seller's coming from. And so I'll just touch briefly on the seller's perspective because that's going to inform like my advice to the buyer. So for the seller, when they go to sell a practice, that's a significant taxable event. And the first question every seller is going to have is how do I minimize the tax bill? And the answer is there's really not much you can do. Because they owe income tax on the gain realized. And the gain is the difference between what the buyer's paying them and what's called their tax basis. And their tax basis is what they originally paid less what they took in depreciation.
Well, let's
So
not
here's a
get
real
crazy. We're getting crazy.
simple example. Let's say somebody buys a CEREC machine. And they pay 150,000. And let's say they choose to depreciate the whole thing right away, right? I'm taking section 179, I'm writing that whole thing off this year. So if they buy it for 150K and they take 150,000 in depreciation, their tax basis is zero. Right? If they bought it for 150 and accelerated over 5 years, and that's going to be over time, and maybe by year 2, I'm just pulling numbers out of the area, but it's down to like 100,000. Right? So if their tax basis, if they've depreciated 50, their tax basis is now 100. So that's the math, right? And so whatever you get paid. So back to my example, they bought the CEREC, 150K. Let's say they kept it, they deducted the whole thing right away. Tax basis zero. 2 years in, they say, you know what, this isn't for me. I'm going to sell it used. And so they sell it used for 80,000. Well, if their tax basis is zero and they sell it for 80,000, they just pick up 80,000 in ordinary income. It's called depreciation recapture. They got to pay income tax on it. So the same thing applies in the aggregate when you sell a dental practice, right? And you look at that allocation, and let's keep it real simple, Michael. We got the $1 million practice. We got 200K to equipment and 800K to goodwill. If the tax basis on their equipment is 50,000, and the purchase price has 200 allocated to equipment, they just picked up 150K of order they have to pay income tax on. You can't change it. There's no hiding from it. There's nothing that can be done. Mm-hmm. So for the seller, where we get into competing objectives, the same thing applies on the goodwill. If it's a startup, there is no basis in goodwill. They owe gain on 800,000. In that example. But the difference is the gain on goodwill is taxed at favorable capital gains tax rates. So if they're in the 37% tax bracket, the gain on equipment is taxed at 37%.
Yeah.
The gain on the goodwill is taxed at 20%. So the only way the seller can influence and lower their tax bill is to push for a lower allocation to equipment. Yes. Because that means a smaller percentage of their taxable gain is taxed at that high marginal tax rate. So it doesn't dramatically alter the tax bill, but it does influence it. Mm-hmm. So that's why our clients have heard me say the allocation is a bigger deal for the seller than it is for the buyer.
Yeah. And I think the buyers at the time, like, I think at the time that the buyers get to the place where you pick them up, mm-hmm. looking at allocation schedule, and mm-hmm. you're getting ready to close, and you're talking to them about accounting and bookkeeping services, and they're just exhausted, right? They're exhausted. Right. They just got their butts kicked. That's how they feel, right? Mm-hmm. They tried to negotiate the price. They may have lost. We started chipping away at the ARs. We won a little bit there. Then they started getting into the work in progress and all the little things. And then the lease starts kicking them in the shorts. And by the time they get to you, they're like, I just want to win somewhere.
Right.
That's what. And then there you are, like, well, you get a little benefit to juice the hard assets, and then they lock onto that. The truth is, this is a big deal for sellers and a very little deal for the buyers, right?
It is. And so to kind of circle this back around, for the buyer, just keeping that in mind, the more you push them on bumping up the fixed assets so you can have your bigger deduction now, you're driving up the dollars on their tax bill. You're literally on the seller's tax bill, and it's going to be a big tax bill. It's sometimes shocking, right, for the seller. You're driving up the actual dollars.
Yeah.
So you just have to be mindful of that. And we're not in the transition space, Michael. That you've already counseled them through this process, and by the time they're asking me about allocation, I will tell them, look, it comes down to a meeting of the minds. Let's say that the seller, they've arrived at like 15% to equipment, and I'll ask the dentist, say I'm, they're looking at hiring us as their accountant after they're in ownership, and I'll say, well, how do you feel about that practice? Do you see yourself there? Do you like it? Does it check every other box? Does it feel good? If so, like, you may not want to jeopardize the deal over allocation, because you still get to deduct the full purchase price no matter what. And the other thing, Michael, is this. Let's say they're buying a practice, and this buyer has maybe a more expansive skill set than the seller, right? And so some of the stuff that was being referred out, they're going to start doing. That's production they're not paying for. They're going to make more money, and they're going to make way more money than they made as an associate. Mm-hmm. And so even though maybe a higher percentage of that goodwill gets pushed off for the next 15 years, when you're making more money, those tax deductions become worth more when you're in a higher tax bracket. So it's not all bad having some of that hanging out in the future.
I didn't even think about that. So if the plan is for you to make more money in the future, it's great to defer some of those tax write-offs to the future.
Right.
And I will say this, as an ex-banker, you usually pay your loan off in 8 to 10 years on average. Mm-hmm. Those were just statistics when I was the lender. So in 8 to 10 years, when you don't have that loan payment and you don't have that interest write-off anymore that we all love to take advantage of, that allocation schedule could be the difference maker. So I didn't even think
it could help. Yeah, it doesn't, people get very excited about Section 179, which, and again, just to recap, all Section 179 is, hey, the rules are, if you buy medical equipment, that's depreciated over 5 years, or Section 179, forget that. Let's just deduct it all right now. And so if you're making, say your practice profit's $400,000 and you buy that CEREC and that's $150,000 deduction, that feels pretty good. Like I'm having that party like right now, and you're gonna have very favorable tax rules that year. But let's just say, okay, we do that, but 2-3 years from now, maybe we're not making 400, maybe we're making 700. You're going to be at a higher effective tax rate, and if you still had some of that CEREC deduction hanging out, that's actually that tax benefit's actually worth more money. So it's not always. It's not always a bad thing to push those off.
I love what you said there. So everybody always talks about Section 179 when you go to the trade shows, and like right now, the Invisalign Align Tech is coming out with this Illumina, and they've got some sweet deal, and this is the rage. And like a hot minute ago, it was something else was the rage. There's always going to be a rage, and then the salespeople always love to talk about this. Section 179. And you're right. Everybody gets super excited about it. So what's the longest you can stretch? Because everybody talks about how, like you said, let's have a party and not pay any taxes this year by putting it all in 1 year next year. I tend to think let's bank it over time. So how long can you stretch 179 out?
It depends on what you're buying, but again, medical equipment, it's 5 years. There's no discretion. It's hard rules. It's like the goodwill. It's 15. There's no option A, B, and C. It is what it is.
But you could do all of it in 1 year, or you could divide it by 5 years.
In the year of acquisition, you have a choice. You could say, let's take half now, and then deduct the other. But whatever's left over is 5 years. You cannot say, hey, let's just start with 5 years and we get to year 2, then let's take the whole thing. No, the year of acquisition, you can choose to take all or a portion of Section 179, and then whatever's left over, if there's anything left over, is 5 years, and it can't change after that.
Okay, so for simple math, I've got $200,000 of hard assets. The allocation schedule, it was $1 million practice. Let's say it's 80-20. 80% was goodwill, 20% was hard assets. So I've got $200,000 if you're following my math. The very first year of the acquisition, I didn't know that half of the 200 could be written off the first year. It could be $100,000. And then you would divide the other $100,000 left over 5.
It has to be over 5 for medical equipment.
So okay, so 20 grand a year, and then that would be the schedule essentially.
Yes, it's accelerated depreciation, so it's not linear, it's accelerated. To geek out, it's double declining balance depreciation, if we want to get technical. So it's not linear on the equipment. Now the goodwill is straight line over 15 years.
Okay. But in theory, like give or take, that's kind of how people should think in general.
Yeah.
Okay.
But here's to go back to what you said. Okay, we're it's year end, the equipment's on sale. And if you hear anything like, well, you don't want to miss out on Section 170, like you never, just for all practice owners out there, you never miss out on anything. It's all just timing. If you don't get it this year, you get it next year. You never miss out. And again, if you're going to make more money next year, the tax benefit is more dollars. It's actually worth more. So I don't get wound up about that. The other thing, just a very key concept of Section 179, is just ordering the equipment doesn't count. It has to be placed in service, which means delivered and in a ready condition. All right, so it has to be installed. It doesn't mean you have to have used it, but it has to be installed to be deductible in that tax year. And the other thing that people can sometimes get confused about is, okay, what if I get a loan? Does that spread the tax deduction out? Or what if I pay cash? Your method of payment is irrelevant. All right, if you buy a piece of equipment and it's placed in service that tax year, that's when you can depreciate it. Whether you do the whole thing or spread it out, whether you got a loan or paid cash, it is irrelevant.
That's really good. Like this is exactly what I wanted out of this episode. Just as kind of a fun little bonus. And since we're into it and we've kind of funneled it all the way through hard assets.
Yeah.
And you mentioned startup.
Yeah.
Because I do have a lot of startup listeners and they're listening to this as well, potentially. How does cost segregation, because we mentioned at the beginning of the episode, how does that play into this strategy, if at all, for an acquisition or a startup?
Cost seg is for when we start talking about real estate, and let's think commercial, non-residential commercial real estate. So you buy your practice, build your location. When you purchase non-residential commercial real estate, that gets depreciated straight line over 39 years. Okay, that's a long time.
39 years is forever.
39 years, it's a long, so that's a very small tax deduction. So one question I get often, Michael, is, well, from a tax perspective, should I buy or should I lease? And I tell people, look, the tax should not move the needle on that decision. You only want to buy real estate if you want to be in the commercial real estate space and you want to own real estate, invest in what should be an appreciating asset, realizing there is risk. A good buddy of mine bought his real estate. It was a good move for him. It was a bank building he converted into a dental practice. It's beautiful. Michael, 6 months into it, the city came and made him repave the parking lot. That was $250,000. He's like, what? I wasn't planning on that. So those are the things you got to think about when you own when you own it, it's your problem. So there's risks involved. So you only want to own commercial real estate if you want to be in the commercial real estate space and you want to invest in what should be an appreciating asset. That's why you own real estate. Don't do it for tax write-offs, because your mortgage interest and your 1/39th depreciation, if you compare those to what your lease payment would be, and the lease payment's fully deductible, it's not a big enough difference, in my opinion, to be a significant decision a factor in decision making. But let's say we go down that road. We say, I really want to own my spot, and you purchase it, either do a ground up, build it, or you substantially remodel it. So again, whatever the cost is, whatever dollars you spend on the improvements, not the land, but the improvements, you get to deduct the whole price. It's just a matter of time. You get to deduct 100%. So what a cost segregation study is that's when engineers go in, it's very specialized work, and they break it down. They look at every dollar you spent, and they look to substantiate and reclassify those expenditures to fixed assets as opposed to real estate improvements, to take it from a 39-year depreciation schedule to maybe down to a 5 or 7.
So essentially, it's like slicing up the asset so that you could find things within the building that could be depreciated sooner. And a good
Correct.
example of that would be, I hear this one a lot. I bought a building and I bought cabinetry and dental cabinetry.
Yeah.
And so let's get dental cabinetry accelerated, not on 39 years, but on 5 or 7 years, right?
Yes.
Or 5 years, rather.
Yep.
Yeah.
So what a cost seg study does, it does not create new tax deductions. It just accelerates them so that you can have them now, because you likely will not own that building 39 years.
Right.
Now, here's the other thing, Michael. Let's say somebody doesn't do the cost seg and say, well, I just didn't think about it, or just, it was on the to-do list and just never did it. Not the end of the world. Let's say 7 years later, they go to sell. They sell the building. Well, whatever your cost is, right? Let's say they paid $800,000 for the building. And let's say, they forgot to do the cost seg, and so they're just depreciating 1/39th, right? And whatever time left, let's say they've depreciated $200,000. So they paid $800,000, they depreciated $200,000. They have $600K tax basis, and then they turn and they sell it for $900,000. Turn a nice, handsome $100K profit. They will owe long-term capital gains on the difference between 900 and 600. So the reason I give you that example is if they didn't take the cost seg, their tax basis is higher. They're going to pay less capital gains when they sell the practice.
Right.
You don't lose anything. It's all just a matter of time.
Interesting. The IRS gets what they want to get. Just
they get paid.
When and how.
Right.
That's cool. All right. Wow. Great episode, Morgan. Like, we went almost 40 minutes here on a lot of different things. At times, it probably got a little detailed and granular, but I think we did a great job of explaining really how you should approach this from a seller and buyer's perspective. We looked at what it is, how it works, depreciation versus amortization. We looked at section 179. Is there any other tips that you would have maybe post-close for buyers or sellers to kind of end cap the episode?
If we just circle back to, allocation, what is that meeting of the minds? And so I think, a seller, one of the bigger challenges to the seller is breaking down the tax liability and helping them with that. With buyers, it is less consequential for them. And I think they'll soon find, once they get into ownership, they're going to have a whole lot more to think about than that little, 4 or 5% difference that it gets moved to a 15%, a 15-year amortization. So in the big picture, I think it's kind of a short-lived concern for the buyer, and they have such an amazing journey in front of them in practice ownership, higher income potential, working to build, because the practice itself, should be an appreciating asset that allows the dentist to enjoy a high income, have some control over their life, and hopefully have a nice high quality life if they put it all together. So I'd say it's the allocation. It's just a step in the process as they move into practice ownership, and it's like you said, it's one of the last ones before you're at the finish line.
Totally. Morgan, how do you guys help? When do you want to be brought in? I always give an opportunity for you guys to just, we could put something in below about your firm and, a little bit about what you guys do.
We love working with doctors that are our first-time owners, whether that's a startup or a practice purchase. We've supported hundreds of doctors in both over the last 15 years. I have always helped them along the way. I don't charge for that. We're not in the transition space, so we don't negotiate deals. We're not involved like you are. But what we do always is if somebody is if they're buying a practice, the time to get us involved is, I'd say, at least 30 days prior. There's no, like, earlier is better. And I'm always happy to be a second set of eyes over the seller financials, just to let them know, hey, is there anything concerning? Is it sort of within the norms that we see every day? And then if they do want some help on that allocation and they decide we're a good fit, I'll help them with that as well, and come to that meeting of the minds. And then ultimately our goal is to support our doctors in ownership and help them with it's the easy button for their monthly accounting. We give them our practice profitability analysis, help them make sure they're realizing that appropriate financial reward that they have in mind when you own a dental practice, and then help them, of course, understand and plan for the tax liabilities that are going to be very different for new practice owners, opposed to perhaps being like a W-2 associate. So that's our world. We love working with first-time owners, and I would say earlier is the better. We like to really get involved and formalize our relationship about a month prior to either the close date or the opening date.
That's about when I'm throwing it over to a CPA.
Yeah, it's perfect. That timing's perfect.
Yeah.
Not that we. Oh, go ahead. I would say not that we don't sometimes get the call of, hey, I bought a practice last week, and well, hey, it's still a good time to get going.
And you guys are a full service bookkeeping, accounting, the whole.
Yeah, that's our I mean, we really have one program, and it's full service. So we build the accounting system and maintain it moving forward. We take complete care of it, and then we give them a full color dashboard style report that's written for dentists. Dentists can actually read, and it makes sense, right? It gives them comparison with our client averages. So like, we want the dentist to realize that appropriate profit margin, so that they have that appropriate financial reward that they should have when owning a business.
And I personally, for the clients that we coach on an ongoing basis after people own, Next Level has many clients that have went through the buyer and startup journey with Next Level, but then they retained us after close and are paired and working with one of our 7 wonderful practice management consultants. I personally love your report because I still get pulled in kind of as a high-level CFO. And when they send me your reports, it makes my job super easy. And so I love those reports. I find that they are just enough, not, you guys aren't trying to be a consultant, but you're also trying to educate them on some basic KPIs, which I love. So yeah, good stuff over there. Yeah.
Awesome. Appreciate that.
Well, I guess this concludes another episode. Again, folks, very important topic in the purchasing a practice process. I never done an allocation schedule episode before, so here we are. Morgan, thank you so much for your acumen and knowledge in the space and what you do for our clients and all the dentists out there. We covered a lot of ground in 43 minutes. And so thanks so much for your time and investment. And folks, thanks for listening, being a part of the program. I would ask you to please review us, give us a 5-star. I don't need a big paragraph of how awesome I am or what weird t-shirt I'm wearing, but you could just simply hit 5-star and submit. That helps us on our rankings. And subscribe, be part of the program. I think we've got private Facebook groups you could be part of. And anyways, as always, thanks for your time, your investment. And I guess that concludes another episode of Dental Unscripted. Thanks a lot. Thanks, Morgan.
All right. Thank you, Michael. Appreciate it.
Take care, buddy.
Thanks for listening. Let us know how you like the show. Rate us on Apple and Spotify. Subscribe and follow for more.